And we are live on Livestream Tuesday. Hey, welcome everyone. Yeah, a lot going on in the world of everything, stocks, crypto, macro, and it's all, yeah, coming together in a way that I'm pretty stoked for, pretty excited for, because I think it actually benefits us in a very big way. And I've been kind of like waiting and waiting, and pretty much everything now has lined up. But before I get into all of that, we're going to cover MicroStrategy because essentially MicroStrategy is halved in what, about 3 months, from like nearly 2000 to what, 11, 1200. Bitcoin has gone nowhere. There's a panic like, oh, it's dead, it's over. Is it? Well, I'm going to tell you. And then generally, I just want to talk about like where things are in the market and why, while the mood is kind of gloomy, I'm pretty bullish. I'm starting to feel some excitement because like I've been waiting for like this setup to kind of like, it's taken forever to kind of like get to a tipping point to like kind of like, yeah, well, let me not give everything away. Let me do all the legal stuff first, which is that this live stream and all the content from ATG Digital Media is not investment or financial advice. It is presented to you as opinion, information, engagement, and most importantly, for some number of people, entertainment. Next, all ATG digital content may contain errors, oversights, and mistakes. The point of this disclosure is that just because I say it doesn't mean that like, it's like 100%, going to be true. I can make mistakes. Information can change. I mean, our sources can have errors. So, you got to do your own due diligence. Also important that understand that investment operations have significant risks and can lead to the loss of your principal. Investment operations is what? Buying or selling a stock, buying or selling crypto, buying or getting involved in option trades. Yeah, all of them have risks. You can lose money. Obviously, we don't have to tell you if you make money because that's what everybody wants. That's obviously not a risk. Last, I, the owners, employees, contractors, own, trade, transact, and the securities that are mentioned in this video and all the content from ATG Digital Media. This includes our model portfolios. But importantly, and I've been meaning to change that, we don't take money from issuers. There has been stuff brewing in my old business, the newsletter business, where some number of folks, without telling subscribers, took money from various stock issuers and recommended their securities. We do not take money from issuers, and generally I try to keep a pretty safe distance, really, even from talking to any of that. I like to do my own research, come up with my own opinions in my own way, largely by really just like looking through the mass of information that is available generally for free. If you are willing to dig, it's all out there. Okay. Free content that we put out, my Substack, which is paulmampilli.substack.com. Please join it. It's completely free. We don't charge you anything. And we actually give out an extraordinary amount of information, including, ticker symbols, the basic sort of thesis behind all trades. I've got this Ballman Speculating podcast, which, to be truthful, is like not a high priority. I try to get to it. And obviously we have YouTube. Social media, we've got X, which used to be called Twitter. Instagram, which is, I'm about to go and see my mom, so I'll put some photographs up of my trip. It's a little bit more of a social rather than like investment. And then Facebook, where periodically I go and do Facebook Live, and Dean is very active in my name, putting up all kinds of interesting observations for you to follow. Quick plug for ATG Digital Media. Subscriptions start from $9.99 per month. Check us out at atgdigital.media. Okay. Let me start with something that I put up on X. All right. And I'm going to start with the macro stuff and then get into MicroStrategy. And I've got like a clip of Michael Saylor, who's the CEO of MicroStrategy, talking for 16 minutes. And what I'm going to do is like play it a little bit at a time, and I'm going to watch the chat and be like, hey, Paul, this is over our heads. This is boring. We don't want to watch this anymore, and we'll drive some interaction. But first, let me start with what is going on, and let me get the comments up here. How do I do that? Oh, yeah. All right. So I put this up on X, which used to be Twitter, and I don't know if you can see it well enough, but essentially, I'll make this full screen. I'll disappear for a bit. Does that help? Nah, it doesn't change the size. In this post, I say, like, this lays out what has happened since the Fed raised rates from 0 to 5.3% between March of 2022 and July of 2023. And you can't see it very well, but essentially it shows the red line is interest rates going up, right? And then there's lines that you can't really tell particularly, and I recommend you follow me on X. Maybe I can make this a little bit bigger. Can I? Is that better? Let me just check and see. Will somebody tell me if that makes it any better? Nobody's commenting, so I mean, I'll just keep going with this. But essentially, you'll see that there's, like, the Federal Reserve starts raising interest rates, and then what happens is that investors initially panic and be like, we're going to have something like 2008. We're going to have a crash in everything. Because we're coming from a period of 0% interest rates, and the Federal Reserve is raising interest rates, and pretty much everything goes down. Stocks go down, bonds go down, and then somewhere, in halfway, once, like, sort of like, the S&P 500 dropped, I don't know, 25, 30%. There was no crash. There was no real recession. There was a bit of a slowdown. And people are like, whoa, this is not meeting our expectations. And so then, to the shock of pretty much, I think, most people, people started buying the S&P 500 stocks, pretty much, like, it's about 30 stocks really drive that index, started buying junk bonds, started buying real estate, and all of those assets have gone up and made new highs. Yeah, right? So you can't see necessarily what it is, but those lines that you can see somewhere, like, what is it, like middle of 2022, they start to go back up, and they go back to making new marginal highs. In other words, they haven't, like, rocketed out of the park, like just continue to go up, but they've made new highs relative to 2021. And most people, thinking about interest rates and how high they are, etc., expected that would not be the case, and that's still where we are today. The S&P 500 is within spitting distance of its all-time high. Junk bonds, which of those lines? I mean, I wish I could show you, but yeah, the really brown line is junk bonds. Junk bonds are at all-time highs. Yeah. Housing. The orange line is housing. You can't really tell, but I'm just, like, giving this out to you, is housing. I mean, housing prices for the most part haven't really corrected. I mean, they're still rising in many places, despite interest rates being significantly higher than where they were, literally 2 or 3 years ago. So, and then we get to, I've used ARKK, which is the ARK Innovation ETF, and that one you can't really tell, but it's the purple line which is there. You can see, like, ARK Innovation, it's back below its low in 2020, and the other line, which is green there, is the ETF for the 30-year bond. So what's going on, and what did I lay out in this X post, which is that the S&P 500 has hit new highs, driven by a small number of mega cap tech and big cap stocks. And I've researched this. I mean, essentially, you've got 20, 30 stocks driving the S&P 500. And then on a wider basis, it's like, I'd say at best 100 stocks underneath that like are contributing a little bit. Then you've got JNK, which is an ETF that represents junk bonds, and then housing, and I'm using an ETF, ITB, also new highs. Meanwhile, long duration assets have gotten crushed. And bear with me, it's a little bit technical. Just bear with me, a little bit technical, right? So what happened sort of somewhere after the Federal Reserve started raising interest rates is that hedge funds, big asset managers that can go long and short, they came pretty much universally to this idea that, well, if interest rates are going up and they're going up because of rising inflation, then innovation assets, growth assets, where the peak cash flows, the peak profits are further out into the future, right, than more mature companies, well, those cash flows and profits are going to be worth less. So, of course, their value, yeah, is lessened as a result of interest rates going up, right? And so they're like, we'll short those. Short means betting on something go down. So what did they short? Essentially, they shorted innovation stocks, growth stocks, and they shorted, long-term bonds, right? And then now they're like, well, hey, what's, benefits in this scenario? Well, anything that has cash flows that are here, present, and near term. So load up on large companies that have a lot of cash on their balance sheet, right? That's right in front of you. Load up on dividend stocks, right? I mean, that's right in front of you. Load up on like junk bonds that are giving out a lot of money in terms of distributions, near term. So load up on everything short term. Go and sell and short to some extent all the stuff that's longer term. But I mean, the world hasn't necessarily turned out the way that they expected. One of the things that those folks who have done this expected is that they expected inflation to keep going up. And while inflation hasn't rolled back to 2019 or 2020, it hasn't keep going up. So some of their bet and analysis, is not necessarily right. And then what we've also seen is that innovation and growth companies have pivoted to producing cash flow and profits. In the meantime, nobody really expected that the S&P 500, housing, junk bonds would hit new highs. And one of the reasons, that it's hit new highs is that those assets and those asset prices held up, and that drew a crowd, right? I mean, many retail traders, maybe even some of you, are like, hey, this is holding up, this is going down. Very natural human instinct to want to keep the things that are holding their value. Rather than understanding like the macro setup that's going on, which is keeping them up at this high. So one of the things that, I know from having been in the asset management game, in the money management game for 30 plus years, is that the real impact of rising interest rates really begins to bite about 12 to 18 months after they're announced. Why? Well, because asset markets, stock markets, you can, what does it take to the Federal Reserve has raised interest rates, you sell, right? But companies, businesses, I mean, it doesn't necessarily hit them all at once, right? The first rate increase, might have no impact on them because they have no bonds maturing. And, people don't necessarily change their spending patterns. But if you look out 12, 18 months, pretty much every rate increase over time starts to bite a little bit at a time. And I know from having gone through, rate increase cycles in the 1990s, 2000s, that this is true. So if you go and look at the timing of things, then, and you go with my 12 to 18 month viewpoint, the impact of higher rates would start to hit the economy and then the markets, because what happens as higher rates hit businesses? Well, the number one thing that really happens is your financing costs start to go up. So if you have bonds that are maturing, you've got to pay higher rates to refinance them. If you want to finance inventory, you've got to pay more when you go to borrow. So that starts to hit the profit and loss statement. That starts to hit your profitability and your margins. Now you start to disappoint forecasts. Investors don't like that, so they start to sell your stock down. And now, you've got this, the beginning of the bite that comes. And so the earliest we would have seen the impact really of high interest rates would be sort of in October, which is quite interesting given that that's when the Federal Reserve, out of the blue, says, oh, hey, we're considering cutting interest rates. And truthfully, even I was in shock. I was like, what? Wait. I mean, inflation is still, is still way up from 2019, 2020. What are you talking about? But but they know. I mean, they're well studied in what interest rates do and how long it takes to kind of hit the market. And so, the earliest hit would come October 2023. On the later side, April 2024, which is about now. And why have things gone to new highs? So, I mean, for this, you have to go with a little bit of theory, which is that we had unprecedented fiscal stimulus. We had unprecedented Fed action to liquefy markets post-COVID. So it makes, and also we're starting from zero, right? I mean, it's not like we started raising interest rates from 2 or 3%. So it makes sense that it would take a little bit longer in this cycle for the impact of higher rates to hit businesses, asset prices. But there is plenty of signs if you are looking at certain real estate markets, what is going on. If you're following stocks, there are any number of companies, for example, that are saying well, our profitability this year is going to get hit. So the bite is definitely unfolding right now. And then, as I put it in this post, the hammer of this rate hike would be when? Well, it would be 12 to 18 months after the last increase. So the last increase I said was when? July 2023. So 12 months from July 2023 would get us to July 2024, which is in about 3 months' time. And then the worst of it, if you will come, say, around January 2025. So when you look at it like that, no wonder the Federal Reserve is talking about lowering interest rates in 2024. Why? Well, because my best guess is that they can see that there are plenty of signs of slowdown unfolding in their microdata that is telling them hey, sooner rather than later. I mean, while asset markets, first panicked and then said, oh, it doesn't matter, we're going to bid everything to new highs. It's going to matter. And businesses, the economy, and markets will need lower interest rates at some point, probably in the third quarter or early fourth quarter of 2024. So that's why they keep talking about lowering interest rates despite the inflation numbers, the headline inflation numbers coming in hot. So I told you that the red line, which is a proxy, meaning essentially it tracks what Fed funds, which is the only rate that the Federal Reserve actually controls. I mean, if that goes to, the Federal Reserve has been talking about cutting interest rates by 1 to 1.5%. So you get to about 4.25% to 4%. And if that's right, then this chart, right? Make this bigger again. I know it's fuzzy, but this chart, which has us here at the bottom, right? Because we're in these innovation growth stocks and crypto, which are all considered long duration. We're going to see this flip. Because the same theory that was used to sell and short these things now in reverse, it benefits us because, I mean, we've got inflation that hasn't gone back to 2019 or 2020, but it is stabilized between 2 and 3%. Meanwhile, the markets have discounted as if inflation was going to keep rising at something like 6 or 7% for the foreseeable future, and that is not what is unfolding. So long duration assets are over discounted, if you will, and there's too much gloom in it. And in the meantime, the condition of our companies, innovation stocks, growth stocks, opportunity stocks, has improved because they have pivoted from like growth at any price to like, hey, we got to produce cash flow. We got to produce free cash flow. We got to produce profits. We got to focus our operations and investments on projects that have a near-term high potential and probability of actually producing cash flows and profits, etc. So the quality of the companies has improved. Their ability to produce cash flows and profits has improved. And in the meantime, the macro structure of the market now favors us. I told you it was a little bit technical, but hey, I always want to provide you the benefit of my experience and understanding and knowledge. So if what I'm saying is right, and obviously there's no guarantee, there's no certainty, this is based on my research, my understanding, my experience, we're going to see a flip. We're going to see a flip. We're going to see innovation and growth stocks and general investments rocket higher, and the other ones go lower. Now, I mentioned this earlier, which is that normally you would expect pretty much like in the scenario that I'm laying out, pretty much everything to get sold, kind of like, what you have in every like, like bear market or something like that. But this chart says that in today's world where, everyone has access to very sophisticated hedging tools. Everyone has access to extraordinary amounts of data, past history. Everyone's hedged. And so the folks who have gone long all the short duration assets, so the S&P 500, real estate, junk bonds, and many other assets that I didn't name, they also have gone short. In other words, they've hedged their long position with a short position with the idea you make the difference. So that means as one goes down, they're forced to buy the one that they shorted. And so you're going to see upward price pressure on the investments that we've been in that have been crushed and that have been destroyed. And so, that's one of the scenarios that, I wanted to lay out, that on macro positioning, which is one reason why I am getting very bullish, which is that we now have everything running in our favor, right? I told you the companies on an individual level, our companies are still growing. I pretty much track all of them. And you can see 12% growth, 15% growth, 18% growth, in some cases 30% growth. The sort of old school companies, they don't really have that. Some have negative growth, 3% growth. So our companies are still, in terms of growth, in good shape. Then they have the additional benefit, which is that they've pivoted to like, hey, produce profits, produce cash flow. Don't depend on investors and keep issuing shares. So they're in better shape in terms of that. And now we've got, the market's positioned where they're all like, all on one side of the boat, right? And we can see it by valuations. We can see it by sentiment. What sentiment? In other words, how people are feeling. And generally just think like, what do you tend to buy? Well, you tend to buy things that look good, feel good. This is why nobody buys lows, but people tend to buy highs. And now we've got the potential for macro, like really coming and supporting us when no one is expecting it. Most people are going to be like, Paul, you're crazy. And people are talking about interest rates going higher. But today, for example, let me share a different tab. We're seeing signs like, that consumer confidence is going low. In other words, some of like the happy consensus that has supported, the existing structure of markets, which is, oh, I want everything short term. I want everything super safe. And, I don't want anything that feels risky. I don't want anything that's like longer term. That's going to break underneath, as interest rates get cut, as conditions in the economy weaken. And the big difference is really goes back to the structure of markets, which is new and which I wouldn't expect really many people who haven't been managing money, haven't followed like sort of like the arc of like investment management. Like 20 years ago, like most people weren't hedged. But today, nearly everyone's hedged, which is why you have these very big shifts happen in both directions rather than just everything being in one direction. Okay. I'm going to now just kind of like swap over to talking about MicroStrategy and Bitcoin, and you can start to pour your questions into the chat, if you will, on what I laid out. But the bottom line to what I laid out is that things are, even though the sentiment for growth stocks, innovation stocks, crypto, opportunity stocks feels down, it's actually the best position that we've been in. Why? Well, the prices are low, the companies are in good shape. The one thing that has not been in our favor, that is not in our control, is macro. I mean, the Federal Reserve controls interest rates, and interest rates matter for every investment. Interest rates are like gravity to the financial system. I mean, like what gravity is to physics, interest rates are to the financial system. So a cut under current circumstances from where we are, 5.3% to 4%, I mean, if like, I don't know, there is a crisis in the commercial real estate market, I mean, the Fed might go to 3.5%. I mean, in that scenario, I mean, our stocks and our investments would rocket higher. Why? Because low interest rates mean that like long duration assets, I mean, they get valued much higher. So that's the bottom line to it, which is that many people are feeling down and gloomy. I'm starting to feel like pretty excited, pretty stoked that like after 3 pretty brutal long years, where a number of things swung the wrong way, and they swung the wrong way in a very large amount. They're set to swing in our favor for a long period of time. And one of the things that, we really wanted to see is that like, well, what would the response of the companies be? And the response of the companies has been to like, cut costs, increase cash flows. And you can even see it in like a company like Tesla, which has 24 billion. And they're like, no, we're going to cut costs more. We're going to focus our projects. We really want to like focus on like what can generate maximum impact. And that is very much in the nature of, of bottoms. Like, I mean, which is that at the bottoms, sentiment is low, enthusiasm is low, desire for additional exposure to the asset class is low. Contrast that to highs when, there's euphoria, there's excitement. People want, happy to hand money over and be like, what should I buy? At this point, people are like, we're exhausted. It's been 3 long years. You're like, oh, Paul, my God, you've been telling this story for like so long. I'm tired, but still like, hey, I wrote this Substack yesterday, which is that the future is digital. The future is ours, and they're based on our companies. So I am very bullish, very optimistic, very positive that, the second half of 2024, we're going to see a huge turnaround and no one will believe it. And markets will start to price this in before the Federal Reserve starts to move. I mean, the weaker numbers start to come in. I showed you the consumer confidence number. If consumer spending starts to roll over, you start to see another bank or two start to go under. The markets won't wait. They'd be like, the Fed's going to go. I mean, they've already told us they're going to go. They're going to go. And, one of the investments that was going to benefit is going to be Bitcoin, right? I mean, the underlying basis for Bitcoin is what? Well, it's a hedge against the US dollar. It's a way to preserve, it's a store of value against, inevitable inflation. And remember, I mean, the Fed's official policy is to have 2% inflation. So in other words, that's guaranteed. I mean, and that's the best of all the central banks in the world, right? That's the best. So 2%, like essentially inflation tax every year. So what is going on with MicroStrategy and Bitcoin? Let me play you this clip, and when it's 16 minutes long. So what I'm going to do is I'm going to I'm going to, oh, I have to redo this, share my screen again. You can tell me if it's going on too long or ask questions, and I can stop the video and answer questions as needed. But it's a tremendous clip, and I really love how clear and how lucid Michael Saylor is in terms of explaining what he's doing with MicroStrategy, and then also explaining Bitcoin. All right, so here we go.
ETFs got approved. And people thought, oh, well, when the ETFs are approved, it may not be good for you because you're trading at a premium. But in fact, the opposite was true, because we have a lot of Bitcoin and we're an operating company. So what you can do, or what MicroStrategy can do that an ETF can't do, is you can borrow against our stock. It's marginable. We can leverage the stock. You can option the stock. We have options, puts and calls. You can short via puts. You can go long via calls. And you can buy our debt or trade it, and we can sell the debt. So all the other spot ETFs are not marginable. They have no options, and they can't issue equity capital via shelf registration. They really can't trade at a premium. They get basically arbitrage back to net asset value, and they can't issue convertible debt. Now, why would you want to issue convertible debt? Well, because if you're a convertible arbitrager, you want to find a company with three things. You want volatility, massive volatility. You want liquidity. You want to be able to trade in the spot market in order to hedge out your exposure. And you want durability or transparency. You want to know that the company is a going concern, is going to continue. So if you think about companies like GameStop, they were very volatile and liquid, but that trade doesn't go on for years and years. And with our company, we're basically holding a bunch of Bitcoin. Everybody knows we stand for Bitcoin. Everybody knows we're going to buy more Bitcoin. Everybody knows we're not going to sell the Bitcoin. So we have credibility, and we're durable. The S&P index has a volatility of about 12. Gold is 10. Real estate, 18. Apple, 20, 22. Tesla, 45. Bitcoin, 75. MicroStrategy is levered Bitcoin with a passionate shareholder base, 120 to 140, 150 something, but more than 100. Okay, so if you know the Black-Scholes equation, if you plug volatility in the Black-Scholes equation, it makes the option more valuable. Nobody wants to buy an option that has low volatility. So we stumbled on a very interesting opportunity, because we're an operating company that can issue convertible debt, and we were able to appeal to a variety of investment classes. For example, one class of investors is public company investors. They want Bitcoin exposure. They can't buy Bitcoin. They can't buy the Bitcoin ETF. They can buy a company that does something with Bitcoin. It's like I can buy a gold miner, but I can't buy the gold, and I can't buy the gold ETF. So they have billions of dollars of capital, and they have to invest in an operating company. And we became the most notable, premier, and the most transparent company. With MicroStrategy, we're going to buy Bitcoin, keep it, and try to accrete more Bitcoin per share. There's another class of investors, the Bitcoin maximalists. They love Bitcoin, but they have money in their 401k, and they can't buy Bitcoin with their 401k, but they can buy a stock like MicroStrategy. Now, why would they like us? Well, would you like to be able to borrow money for 7 years for no interest? And buy Bitcoin?
Like free money.
You would like to, but you can't.
Yes.
But we can. So if you like that prospect, they would buy our stock because they feel like they're along for the ride, right? They're getting advantage of our ability to get cheap capital to buy Bitcoin. Another reason is, would you like to borrow against Bitcoin from your bank? Well, you can't because the bank doesn't take the Bitcoin as collateral, but MicroStrategy stock is marginable. So you could pledge it as collateral and borrow it at SOFR plus 50 or 100 basis points. So that way you get to keep your Bitcoin and take a pretty cheap margin loan against it. So some people like that. A third class of investors want volatility. There's something called MSTY. It's like an ETF that sells MicroStrategy volatility.
Okay.
It generates 100% plus dividend yield. Okay, so if you
Nice.
just sell the calls, you know, you could own the Bitcoin and sell covered calls out of the money or in the money, and then you generate some yield. So some people like
Is it
that.
issued by you or
No,
by
we
someone
don't-
else?
No, it's somebody else.
Somebody else. Okay.
Other people. But the reason that they do it against us is because we have Bitcoin and we have options. There are billions, there's like 30, $40 billion of open interest in the MicroStrategy option market. Well, there are no options on the spot ETFs, you see, and you can't borrow against them. They're not marginable. So we had this company that was optionable, marginable. It was high volatility Bitcoin equity, but it's also highly levered Bitcoin equity. So Bitcoin would go up and we would go up more. And so if you like Bitcoin, then if you like the idea of taking all your money and buying Bitcoin, you would like the idea of borrowing a lot of money for free and buying even more Bitcoin, right? So,
Yes.
so a lot of those people decided to buy in as equity holders. Then you get the haters, right? People that don't like Bitcoin. Well, if you want to short Bitcoin, then you could short our stock.
Yes, exactly.
But what if you wanted to short the stock with options and puts? Well, there aren't puts on the spot product, but there are puts on MicroStrategy. So you could go and you could buy, and there are billions of dollars of short options traded on our company. So there's those people, they just hate Bitcoin. Then there's people that are they're not sure, they hate our business. So like, we're going to short you and buy Bitcoin.
Okay, yes, exactly.
Right? And so you have those arbitragers. And then there are people, they don't even know what Bitcoin is. All they know is they can generate 100% yield.
It's going up. Yeah.
And then there's people that are the super option traders and they think, well, you know, the options 6 months out are mispriced versus the options 3 months out. So I'm going to sell the options 6 months out and buy the options 3 months out. And I'm going to take advantage of that. And then you have the fixed income investors. They can only buy bonds, so they could buy our bond. And then you have the convertible arbitragers. They need a convertible bond, and they're going to actually short the equity, buy the bond, capture the yield. And then you have people, what if you wanted to buy Bitcoin at the all-time high, but you don't want to have the downside? What if you want 80% of the upside, 20% of the downside? Well, if we sell a bond and it's a $500 million bond, but we've got $5 billion of unpledged Bitcoin, you have this collateral, like 10-to-1 collateral, and you could say, well, Bitcoin would have to trade down by 90% before I'm in trouble. So if you're risk adverse and you want Bitcoin upside, but you're afraid to take 1-for-1 downside, you would buy the bond. And of course, you can construct any type of instrument you want by trading the bonds, the equity, and the options, and you construct whatever you want. So what happened then is MicroStrategy stock started trading a lot, billions and billions of dollars a week, and then billions of dollars a day. And then the options started trading. And so then we went back to the market and we did a bond issue, and I guess it was going to be about 500 million, but it got upsized and became 800 million. And we did that at 62 basis points at a big premium. So we basically sell the bond for 62 basis points, and then we buy the Bitcoin and we capture the yield difference, or we capture the premium. But then, of course, we basically borrowed $800 million for 6 years to buy Bitcoin. If Bitcoin goes up 24% a year, then you could double your money twice. So maybe you actually make $2.4 billion on the back end, some hundreds of millions of dollars on the front end, and you do it while you're paying 0.5% or 62 basis points interest. So we did that. People liked that. The stock traded up. Bitcoin traded up. We announced we closed that deal on Monday, and we thought, why don't we just do it again? So we went back and we did it again on Thursday. And we did 600 million on Thursday, and we did 1.4 billion total in that 2 weeks. And why can we do that? Because it's very hard to find a company with 100 vol with billions of dollars of liquidity where you understand the business model. And we built a lot of trust and credibility with our investors because they all know what we're going to do, right?
Yes, exactly.
I'm very famous for you do not sell your Bitcoin.
Yeah.
We're going to buy more Bitcoin. We'll keep buying Bitcoin. If we were not transparent, if I was not predictable, then you don't know what we're going to do for the next 5 years. So you're not going to want to take a 5-year bet or even a 1-year bet. If you hate Bitcoin, you want me to love Bitcoin because because the last thing you want to do is short $100 million of our security and have me say over the weekend, I reversed the trade.
Even if I hate you, I want you to be like trustful that you're going to be buying, like as you say. Yeah.
But the opposite is also true, which is I don't mind if you hate Bitcoin. If you short our stock, that just means you're buying it in reverse. Like you're going to short it now, but eventually you'll buy it later when I need you to buy it. And so what we did is we created an operating company, and we realized at some point now we're a Bitcoin development company, like a real estate development company. It's like if you took a company public and you sold billions of dollars of securities to buy those buildings. The trick is, can you get the cheapest financing? A public company has cheaper financing than a private company because it's more trustworthy and transparent, right?
Yes.
You have to make thousands of pages of disclosures. You're bound by a lot more restrictions. So a public company in America is probably the most trustworthy of a corporate vehicle for issuing security and raising debt. So you would have an advantage if you were a public company and you were doing real estate development. But remember what I told you about volatility.
Yep.
The volatility of real estate's 20 or 15. You can't sell 100 vol equity and invest in 20 vol assets because at some point the volatility in your equity goes to 20. You see?
Exactly.
What we were doing is selling the 100 vol plus equity, and then we're buying a 75 vol asset, levering it up to make it back into a 100 vol asset. So if you're actually creating a volatile balance sheet that will drive a volatile stock, that creates the options market, and that creates the opportunity to raise money for less than 1% interest unsecured. Now, that is unique to Bitcoin. Maybe it's the first time in the history of Wall Street, you have a property asset or a commodity asset that is appreciating because it's hard cap 21 million, right? It's a scarcity.
Yes, exactly.
So it's appreciating and it's volatile. And most people in corporate finance are taught to avoid volatility. They're taught that volatility is a bad thing. So they get rid of all their capital. And if they invest money, if you had $1 billion on your balance sheet, you wouldn't buy something volatile. You would buy treasury bills. But treasury bills are volatility 5. Like they're the least volatile thing you can possibly buy. Okay, so how do you arbitrage that? And so you think about a big company. A big company, it's run to have visibility for the next 3 years. I give you guidance for the next 3 years. I want to know what I'm going to make a year from now. I tell everybody, and then I have no capital on the balance sheet that's volatile. So there's nothing that's going to move, and I consider that success. But if I know what's going to happen for the next 12 months, why would I trade the stock every day? I can just make a decision once a year. So the result is Microstrategy stock trades more than all these big, large cap companies, right? We end up because, McDonald's and Coca-Cola and Nike and Walmart and Pfizer, they're all very predictable.
Yeah.
And predictable is good for people that are afraid of the future. But predictable is awful for the options market and it's awful for traders. So in this particular case, what we've done, it represents a lot of different paradigm shifts. First of all, it's based on Bitcoin, which is a paradigm shift. It's a digital commodity instead of a physical commodity. That's a big idea. $1 billion of digital energy instead of $1 billion of oil. The second big idea is Bitcoin does one better. It turns the commodity into a scarcity. It's the only commodity in the world that's got a cap of 21 million. Every other commodity like soybeans or oil or natural gas or gold is infinitely producible. So there's a lot of price supply elasticity.
Exactly.
That's why it doesn't make sense to buy billions of dollars of oil and hold it for 10 years. That's why we don't use oil as a treasury reserve asset, because there's too much of it. So Bitcoin is a scarcity. That's the second revolution. The third revolution is using Bitcoin as a treasury reserve asset instead of sovereign debt, instead of treasury bills. Well, treasury bills have an effective after-tax yield of 3%. The cost of capital of a company is probably 12% if you basically take the monetary inflation rate and add in 4% for risk premium. So if your cost of capital is 12% and you're investing at 3%, you're losing 9% of your capital every year. Well, Bitcoin's been appreciating at 20 to 50%. So we're not doing a third or a quarter of the cost of capital. We're doing double to triple to quadruple. So if you have a treasury asset which beats the cost of capital, then it's not dilutive to carry the money. It's accretive. Like the conventional wisdom is when you sell stock, you dilute the shareholders. But in our case, the more stock we issue or the more money we raise, the more we accrete. And so hundreds of thousands of companies have assets on their balance sheet which are dilutive. And Bitcoin is the first major asset which is accretive. So we turn the entire treasury strategy upside down by actually accreting assets. Today we have $15 billion of Bitcoin on the balance sheet. And the operating company generates $75 million a year in cash flow. And the operating revenues are 500 million. So we made the balance sheet the primary part of the company instead of the P&L. Everybody else wants the balance sheet to go to zero or negative, and they want the P&L to be the primary part of the company.
All right. Well, that was a long video. It was 16 minutes, but there were a lot of important points there, right? I mean, that you may or may not have caught. And so the basic idea, like if you're own MicroStrategy, you're thinking about MicroStrategy, I mean, the key points are this, which is like, this is a company that it's bet its present, its future on Bitcoin. And it is using, I mean, so many different things in financial markets to optimize how much Bitcoin it can own at the cheapest financing rate in a way that so many people can come and participate. So when you go through a day like today, so I think like MicroStrategy stock is like being marked down 15%. Because why? Well, I mean, I don't have a bead into exactly why, you know, somebody who bought MicroStrategy yesterday for whatever, 1,400 is willing to sell for 1,100 today, because going down, you know, is like what like we experience. But the reality is that, you know, going up and going down means somebody paying a higher price, somebody paying a lower price. So why? Well, I mean, one set of explanations is that there is, as he said, there is a large now, you know, group of people, option traders, stock traders that want to bet the quarter of every single quarter. And they are, in and out of MicroStrategy stock, not based on the long-term strategy that he laid out, which is what? Which is essentially to sell debt very cheaply, and buy Bitcoin. I mean, that's the essence of the whole MicroStrategy game. In other words, we are being offered money at like under 1%, and we're buying an asset that has a historical record of rising at about 20% with something like 70%, up and down movement as it goes up 20%. I mean, that sounds insane, but that's been the reality of Bitcoin. It's been like, annualizing in excess of 20%. So if you're getting 0%, I mean, and you're buying something that's appreciating at 20%, but in a very volatile form, right? Yeah, some people are going to hate it. Some people are going to love it, whatever. But if you're owning the stock, essentially you're going to get Bitcoin performance plus the benefit of like the leverage. In other words, if, you know, he talked about raising 600 million on one day, another 800 million the next day, and buying Bitcoin. I think their average price is probably something right now at, my guess is like 38, 40,000, but they're going to keep doing this. Why? Because they've made the bet that Bitcoin as like the apex asset, the primary asset that has absolute level scarcity. There is no asset in the world that has absolute scarcity. There's no asset in the world. I mean, gold, people will talk about, but the production and supply of gold like rises between, 1 and 3% every single year. I mean, there's always a new gold mining company. And if you lift the price enough, people will go and pursue, a mine that requires even more money, etc. So the supply, can constantly rise. But with Bitcoin, the supply is fixed. It's 21 million. It's 21 million. It's always going to be 21 million. And then with these halvings, you get essentially the supply shrinks in algorithmic fashion every 210,000 blocks, which averages out between sort of 3.5 to 4 years. So that's the bet that they've made. So any given period of time, there are going to be periods of time when Bitcoin is rising, and you would expect then, MicroStrategy stock to rocket higher during these periods. And when Bitcoin's falling, it's completely normal to expect that MicroStrategy stock is going to people are going to, buy it at the high, sell it down at the low, and rinse and recycle. And that is not a bug, if you will. That is a feature. In other words, Michael Saylor, the man that that you were listening to for 16 minutes, has thought actively about this in deliberate, intentional fashion. And it's like, people want to make all these bets on Bitcoin. People want this kind of a structural bet. And we serve the convertible debt market. We serve the option market. We serve people who want to short something in certain ways. So nothing here is abnormal. Nothing here is out of design. This volatility in MicroStrategy stock, like he said, is going to be like 100%. And guess what? Well, what was it at? Like 2,000, and it's now, about 1,100, 1,200. So we're pretty close, right? This is like the swing up and down, up and down. And that is, as crazy as it sounds, by design. In the long term, though, right, MicroStrategy will do, in a more volatile fashion, better returns than Bitcoin. So bottom line to what is going on with MicroStrategy is that, well, we own it in the gold tier portfolio. We've owned it in the gold tier portfolio since October of 2020. Just let me make sure I'll look this up. I think it was October of 2020. MicroStrategy, where are you? MicroStrategy. October 20th of 2020, the price at the time was $169.07. That's our recorded price for MicroStrategy. And obviously at $1,999, didn't quite hit 2,000. If we had sold it, we'd have this huge gain, but I'm expecting Bitcoin to rocket higher. I've covered this idea extensively. If you watch the live stream for a Bitcoin halving, I showed out my model. I've done a standalone video on this, and I've come on this channel, written on Substack, written on X. Like, look, it's a trade that at its essence, the Bitcoin trade at its essence is essentially there's endless amount of fiat that's going to be issued. There's never going to be a time when the United States doesn't issue more money. The idea that they're going to ever cap the supply of US dollars is, I think, that's like not a thinkable proposition. If it's not a thinkable proposition for the United States, it's not thinkable for the European Union or for the Australian dollar or for the Chinese renminbi or for the Japanese yen. In other words, the whole world operates on unlimited supply. And then we have this one asset, which globally is recognized, accepted, valued, that has limited supply. And as more and more fiat gets issued every single year, In some years in gigantic quantities, some years in slightly small. There's more money, but it's like, well, yeah, I mean, I work for a living and then I put my money in this fiat asset, and at best case scenario, it'll go, its value declines by 2%. Meanwhile, you have the alternative, if you believe, if you agree, if you think, to put your money into an asset that has a historical track record now of about 15 years of rising at like 20%. Right? But obviously the rise is relative to the amount of the growth of fiat. So it makes sense that, if you go through a period when, governments, central banks are issuing a lot, well, Bitcoin will rise even faster. So we've gone through a period over the last 5 years post-COVID where explosion of spending by governments, explosion of issuance of money by central banks. Yeah, I'm bullish. I'm bullish on Bitcoin. I'm bullish on MicroStrategy. Obviously, they're both going to be incredibly volatile. Nonetheless, I mean, there is nothing, no stock, no investment has kept up with Bitcoin since its beginning. And so, I will end it there and take some questions over here. Peter says, I got a letter from Banyan Hill letting me know that's where I started following you. Well, I appreciate you following us here and attending the live stream. Some comments on the picture. I apologize. I probably should have gotten the picture there. But the bottom line to the macro structure is the bottom line that I want you to understand is this, which is that if you're a new investor, if you are a non-professional investor, the idea of hedging is somewhat sort of exotic, complicated, and sophisticated because, like what Michael Saylor was talking about, you would use option, you would use leverage ETFs, you might use futures. And the whole idea is to reduce the volatility of your portfolio. Why? Because, well, if you can reduce the volatility of your portfolio, well, then, hey, if you call up, let's say, if you were a fancy, sophisticated investor and you've got, I don't know, $20 million, you call up your financial advisor and say, hey, can you wire me $1 million? And they're like, no problem. So then they issue a call to XYZ hedge fund, so-and-so asset manager. And obviously, if at that moment you don't have money, you're not hedged, that means you might take a loss, which means your results are bad. So, asset managers get fired for having extraordinarily volatile results. I mean, I know this myself. I mean, we got fired by a number of clients in late 2008, 2009 because we had essentially a long-only strategy. And the stocks, when they decline, our performance went down. So, hedging is pervasive. It's done by all the big investors. And so this idea that hey, people are all locked in on these short duration assets. They're all also equally locked in on betting on the decline of other things. You want to be on the other side, in my opinion, in my judgment right now. Why? Because the macro situation is setting up where the Federal Reserve is telling you we want to cut interest rates. They clearly are seeing enough weakness in whatever they are looking at to go out and put out a plot as long ago as October. It's just that we haven't people in markets can react in real time, but the economy, businesses, they react in a little bit slower time. So we're going to see something unfold in the second half this year. And in my judgment, my opinion, interest rates will head down. And with that, this trade will reverse. So all the short duration stuff will go this way. All the long duration stuff will go this way. And if I'm right, it's happy times. And that's the bet that we have made across our portfolios that's there. I mean, and this is a somewhat sidetrack of a point, but once that happens, there's a sort of an after effect that happens, which is that if the Fed cuts rates, it's going to once again unleash the deflationary tendencies of innovation companies. Newer companies will tend to cut prices. They have new ways of doing things that cost less. So there is a possibility that, the interest rate cuts might be greater than 90 basis points, because if it's, innovation is unleashed, yeah, I mean, inflation would now start to trend down, and that might mean like, yeah, I mean, obviously the value of long duration assets are more because they're gaining market share, higher cash flows. Either way, that's a separate point for another day. Okay. Anthony Perry says, let me put this up. How is your option service performing in Platinum? I'm wanting to try it, but I'm wondering how it's working out for the subscribers that are using it. Well, it's obviously you're betting on options, and you have to get a lot of things right. You have to get the stock right or the investment right, then you have to get the timing right. We only do, for the most part, we do calls, but sometimes we do calls on inverse ETFs. So we will make bets going both ways, but still using calls. I believe that Dan, our amazing analyst, said that like we've had a bit of a run as markets took off from October till March. We had something like 20 plus like in a row. But the current portfolio, yeah, I mean, most of those like reflect, yeah, the current markets, which is that they're all at losses, but many of them have come back. I mean, for example, we had, I think Snapchat. Yeah, we had that in the portfolio, which we put on earlier. And yeah, they reported earnings, huge volatility. What was a 60% loss position, we closed it out at a near 20% profit. So it definitely goes up and down with the markets and what we are seeing. If you're looking for guarantees or certainty, it's not a strategy that you should pursue. It is, very much in the nature of markets, which is that we want volatility. We want to make bets that volatility is either going to continue or going to reverse. And obviously we're never going to have anything close to like 100% certainty there. Our goal is always to try to get to 70%, but the truth is that we get to 70% when conditions favor us. When conditions are completely against us, it's like, we get 30%, and most of the time we're probably muddling somewhere in between. I hope that answers your question. John says, I'm thinking about adding to my DDD position. Things are pretty bearish. They're moving to a big three accounting firm and still have not submitted their final 10Q for 23. Yeah, I mean, the one thing I'll say is that, focusing on only one stock when you have an array of stocks, all money's money, right? I mean, if you focus only on one stock and just keep adding to one position rather than building a portfolio, I mean, what if I'm wrong about 3D systems? Maybe it's Stratasys that soars. Maybe it's Protolabs that soars. Maybe it's Xometry, which is in our gold tier portfolio. Like, in other words, I could be right about 3D printing, but wrong about, I could be right about 3D printing, but wrong about 3D systems. So focusing on one stock because the stock price is low and like piling in has risks that like you have to think about. And I would say not only that, like, what if some other industrial technology comes up and takes over the position of 3D printing? You want to own a portfolio. You don't want to get locked in and focused in on one technology or one stock, one industry. You want to give yourself as many chances to win. Having said that, yes, it does look like 3D printing and generally these, what I'll call these new industrial stocks, they look washed out. We actually put a laser stock back into gold tier this morning. And so I'm, in terms of like what you're saying, I agree, but I would say there's a lot of different companies that you can bet on that also give you a different chance to win in a different way. Tammy Klein says, wondering about the Tesla option. Will it come back by the expiration dates? Also, thoughts on ETHE rocketed up and down. Tesla option, we have 16 days left. I believe let me look at the price here. The Tesla option, which we put when, almost like 3-4 months ago when things were flying, the strike price is 230. So we need another big surge. I mean, for us to, our break-even price for that is 266. So we need Tesla to go over 266. So odds are that we don't make it, but still Tesla, as Michael Saylor was telling you, is one of the most volatile stocks in the stock market. Who knows? I mean, we still have 16 days. My best guess is at 140. Nobody would have bet that Tesla was going to be at 190. So who knows? At this point, odds are that that's in all likelihood a total loss, but I've seen Tesla come back in a big way before. Let's see, other questions. Let's see, this one from Diamond Hodel. If the Fed doesn't cut interest rates on our national be 1.7 trillion by December. Yeah, I mean, the thing is that our debt has been, what? I mean, we've been at 34 trillion, we've been 30 trillion, and our debt competes in a world where we are still the best credit on earth. And that is reflected by what Michael Saylor said, which is that the volatility on short-term debt, on treasury bills, is nothing. In other words, it's 3%. In any crisis, in any crash, what do people all around the world, including you, what will you reach for? You will reach for US dollars in cash, liquid cash. So that is the reality, which is that we issue debt, and relative to everything else other than Bitcoin, it is still the most desired, valued, wanted asset on earth for day-to-day living, for buying any asset. You want to buy a house, you want to move to another country. I'm going to visit my mother in India, and I can tell you, I can walk around with US dollars and nobody is going to say no. So there's a relative game and there's an absolute game here. Unless the world says, hey, we are unwilling to buy your debt, unwilling to fund you because we have something better. Yeah, it's not clear to me that the national debt is going to be like the critical factor for the Federal Reserve in determining whether or not, it should cut interest rates or not. Liz, always good to see you. Shout out to you. Thank you for all your enthusiastic support. Let's see, one last question here. What is the prediction for biotech MNKD? Well, there's no prediction. This is a stock that has an extraordinarily bullish future, in my judgment, in my opinion, based on 2 approved drugs. One, which is partnered with United Therapeutics, which is also holding in gold here, and one fully owned drug, which is fast-acting inhalable insulin. Both of these drugs look like they have multi-billion-dollar futures and potential. And if that's right, then yeah, I mean, this is trading at a crazy low price relative to that future. No guarantees, no certainty, but the facts, the evidence, the observation suggests that like sometime into the future, this potentially could be one of the dominant biotechs that trade in the marketplace. All right, we have hit a record for how long I have gone, 1 hour and 7 minutes. We had 73 people on. Thank you all for attending this live stream. Going to quickly put up subscriptions info, $9.99 a month. I'm actually going to be doing a special purple tier webinar tomorrow at 5 p.m. discussing in detail the macro thing that I'm talking about and taking questions as well from purple tier members. So if you subscribe, you will have access to that. So check it out. And with that, with no more questions, I want to thank you all for attending this live stream. I actually am going to be traveling to India to see my mother next week. So I'm leaving on Tuesday morning, very early in the morning. Let me know if you would prefer to do a Monday live stream. You know what? I'm going to be doing a Monday live stream. So if you want to catch it, that's when I'm going to do it so I can still get it in. And then probably the week after that, I might actually do it on Wednesday because I get back on a Tuesday. I'll probably be pretty tired. So slightly altered schedule. Next week, live stream will come on Monday and the week after that on Wednesday. So hopefully you can still join us. Thank you all for being on this live stream, for supporting ATG Digital Media. This is Paul saying bye.